Have a great day.
If you're planning to buy a new home or an investment property, chances are you're going to be talking to the banks or a mortgage broker about how much you can borrow. However, the big banks' changes in lending policy seem to be making it harder to get a loan today. To get a better understanding of what's happening, we're joined by expert Michael Yardney, the CEO of Metropole Property Strategists. Michael, good afternoon. Good to see you again. It certainly is getting a lot tougher for people chasing a loan at the moment, isn't it?
It definitely is. The world of finance is changing in front of our eyes, but home buyers and investors are just going to have to keep up with it. The banks are money shops. They actually want to lend you money. They're just finding it harder to do.
Look, recently Westpac cracked down on home buyers and investors, trying to weed out liar loans. There's a lot of stuff that's come out in the Royal Commission in the past month or so. Can you please explain these changes and what they mean when you're applying for a loan?
Sure. Well, really how much you can borrow is going to make a difference to how big a house you can buy as a home buyer or as an investor, how affordable things are going to be. So it is important, and that's why I've often thought that property is really a game of finance with some houses thrown in the middle. But currently the banks are looking with much more scrutiny at your income as well as your expenses. And this has come about in part because of the Royal Banking Commission that has brought up some very interesting things, as we've discussed on previous shows. So the banks are under scrutiny and how they assess our loans. They're meant to be doing responsible lending. So what they're saying is you've got to tell us not only what your income is, but what your expenses are, because they want to see what you can afford. In the last couple of weeks, Westpac Bank and its affiliate banks have come out and they're wanting to any potential borrower to break down their expenses into 13 categories. They want to understand what your groceries are, what your gym membership is, what you pay for your pet food. It's really interesting how detailed they're getting, and they're putting the onus on brokers and on the borrowers to be honest about this, because, as you said, there have been some of those what we call liar loans where people haven't fully disclosed everything, Sophie.
Like how sort of detailed is that vetting process? Because it's normally just filling out a form. How do they know that you say you spend $50 on pet food when you really spend 200? You know, how are they qualifying some of this information that's coming through?
That's a good question, because it's only just come about. So currently they are not asking for receipts or accounts, but what they are looking at is your bank statements. And your bank statements and credit card statements usually show what's gone out. So if you say that you're spending $15,000 a year on your various living expenses, but the credit cards and bank statements show it's 25, they catch you out. So it is important to keep your records correct, and the onus is on you as the borrower, but also on the middleman in many cases, which is the mortgage broker, to do this. The problem is that it's going to take much longer to substantiate your loans. They're suggesting it's not going to lower your ability to borrow, but it probably is. We know how that sort of thing works. But if nothing else, it's going to make it harder and slower to get a loan, and that's slowing down the home lending at the moment, and that's one of the reasons our markets are slowing a little bit, Sophie.
So, Michael, one of the other issues that's come up, of course, is that there's billions of dollars being held in interest-only loans, which, of course, will come to term or expire in a few years. So this seems to have created a couple of scares for various people. Do you think that that's going to have a major impact?
The Reserve Bank has suggested they're a little bit concerned, because you're right, there's about 1.5 million borrowers having about $500 billion worth of interest-only loans, and they're going to come to expire. Their terms are going to expire, and many of them are going to swap over to principal and interest. So the concept is that you're not only going to have to pay the interest, but a little bit of the loan off, the principal as well, which means for many people their loan payments will be higher. Now, why some people are a bit concerned is that's one of the triggers of the 2008 subprime crisis in the United States, when all of a sudden a whole lot of variable loans changed. I don't think it's going to be as big a problem here, because many homeowners are ahead in their payment. Not as many as before, but a lot of people, as interest rates have gone down, are still making the same payments. But with 1.5 million people having interest-only loans that are going to become possibly principal and interest in the future, if it's only 10 maybe 15%, it still means 200,000 Australian families are going to experience a level of hardship, and that's why the Reserve Bank alerted us to this, just to be careful.
So what can a borrower do to make themselves a bit more attractive to a lending institution?
Right, well, one of the things borrowers have to do is recognise that the banks can be fussy and are being fussy at the moment. So number one, save a deposit and show a savings record and show what you can do. Number two, have your records, your accounts, your paperwork all up to date, because as we've already said, the banks are being much more careful and wanting to look at that. So your latest pay slips, make sure your tax return is there, have all your credit card payments ready. Get rid of any unnecessary loans, because the banks are cautious about what other loans you've got. If you've got a number of credit cards, and many of us have multiple credit cards, even if you don't spend the limit, the answer is you could. So the banks don't like the fact that you've got store cards and credit card limits, and so what they suggest, or what I suggest you do, is actually get rid of unnecessary credit cards or lower your limits, so that actually increases your serviceability considerably. The other thing is, if you're now going to be looking for a property, you've got to be a bit more careful. Make sure you've got a pre-approval in place so you don't get caught out. And if you are going to buy a property, buy one that the banks like, because the banks have got blacklists of postcodes where they don't want you to invest, and types of property they're not going to lend as much against, and that's often the inner suburban areas where there's multiple high-rise blocks that have just come up, the inner city areas as well. So make yourself attractive to the banks, because at the moment it's in their hands, and if you can tick all the boxes, they're much more likely to lend you some money.
All right, just quickly before we go, do you think mortgage brokers are best avoided at the moment? They've had a lot of bad press coming out of the Royal Commission.
Yes, they have had bad press, but the answer is no. They are the conduit between you and the banks. The banks have had more bad press. So the banks won't tell you a whole lot of things. They won't tell you that mortgage fees are actually flexible, and if you ask for less, they'll lend you less. They'll charge you less. They won't tell you that some of the fees can be waived. They won't tell you that the fees are where they make a lot of money. The banks won't tell you to shop around to other banks, that they can only sell you their products. The banks won't tell you that they're there as salespeople to sell you life insurance and credit cards and other loans. So I think a good, proficient mortgage broker is going to rescue you at these more difficult times rather than harm you, Sophie.
All right, certainly a good message to keep in mind. Michael Yardney, thanks so much for your time, as always.
My pleasure.
Suburbs surrounded by water in Sydney.